Okay, so first up today, we're going to talk about the ITIN program that we have available. So you can see, I first brought up a copy of our matrix. You can, and I do want to go over the matrix a little more in detail than we have on previous programs, just because the ITIN is a little more specific. And we do have some different categories in terms of credit qualifying and trade lines. There's some more buckets for loan amounts. So I really want to make sure when we're going through these ITIN loans, if you think you have one, that you're pulling up the matrix and really making sure that it fits with what we're currently offering. So you'll see at the top, right now, we only have buckets for primary residences. At this time, we've decided we're only going to do I-10 for primaries. If you have a second home or an investment property, particularly if the borrower already owns a home and is looking for, a second home, or they're a seasoned investor, they have a mortgage history, do feel free to go ahead and submit it. We might consider an exception for that. But right now, per our matrix, what we're offering is a primary residence option. And you'll see there's two categories here. We have an Alt A, and then we have a recent event. And the difference between these two comes down to the housing history and any credit event seasonings that the borrower has. Alt A is going to be your better credit borrower. They're going to have 0 times 30 on their housing history, and we need them to be 48 months out from any derogatory housing events or bankruptcy filings. They also have a more strict trade line requirement for the Alt-A program. For the recent event, you can see we can have at least one 30-day late in the previous 12 months. We need no 60-day lates in the most recent 12, but if we do a 24-month look back, they can have a 30-day late in that previous 12-month history. We still don't want any lates in the most recent 12 months for LTVs over 75%. And then you'll see it's a 1-year seasoning on foreclosures and bankruptcies. Of course, with Alt A, with the higher credit borrowers, you'll see we have higher LTV offerings. So if you have a 700 FICO and you have a loan amount of 726, 200 or below, and you're doing a purchase or a rate term, the max we can do right now, we've opened it up recently, is 85%. I do want to point out there is a little asterisk there. If you go down here, you'll see that the max is actually still going to be 80% for any properties in California and Illinois, just due to some value issues in those two states that we found. So we are still capping the LTV in those two states at 80, but any other state that we can do business in, you can go up to 85%. If you've got a 680 FICO, you are capped at 80%, and then you'll see some other options for loan amounts going up to our maximum of 1.25 million for this program. You'll notice the higher loan amounts are only available, again, to these Alt-A borrowers. We do cap the loan amount at 825 for your recent event credit borrowers. We do have a minimum loan amount of these still of $100,000. And then the max cash out is pretty standard, 500,000 with residual income of 1,500. I do also want to make a note to point out the standard DTI is a little bit lower for I-10. We do have that capped at 43%. On our other options, we can go up to 50% as a standard DTI. But you'll notice that we can go up to 50 or 55% on a case-by-case basis for these. It depends on if the borrower has multiple compensating factors. We may be able to expand that DTI option, but the standard as you're going through these, just remember for I-10 is 43%. And looking at the income, again, right now, we are only offering a full doc income option for I-10 borrowers. That's requiring a pay stub, a written VOE, a W-2, and tax returns for these borrowers. We do require all 4 of those items up front when reviewing the income. So please make sure you're submitting all of that. Again, if you've got a bank statement borrower or a different income type that you want us to consider, please let us know. We might be able to make an exception. Again, especially if the borrower has a history of owning a home and has paid on mortgages before, that's usually what we're looking for. And this is open for single family residences, PUDs, townhomes, 2 to 4 units, and condos. There are some LTV requirements for the 2 to 4 units or condos as well. All right, so that's pretty much the basics of the ITIN program. I'll go through and just point out some other features that we do have. Again, so like I said, primary residence only, up to 85% in certain states. In terms of documentation we need from the borrower for I-10 loans, we are going to ask for a copy of their current valid driver's license or a government ID. As well as their ITIN letter or card from the IRS validating that ITIN number that they have. You're going to pull credit for these borrowers, obviously using their ITIN number. We do require still a full credit report pulled with that I-10. When you're looking at the credit report, I do want to point out that we specifically are going to use the score that TransUnion is reporting back. So we'll look at all three and we'll look at the full tri-merge report, but when it comes to qualifying the rate and when you're looking to see what bucket they fit in for LTV, make sure you're paying attention to that TransUnion score. Typically on our other programs, we use the middle score, but in this case, again, even if it's the higher, lower, whatever TransUnion is reporting is what we're going to use. One other thing with properties, Texas cash outs are not eligible for I-10 right now. And then in terms of properties, high-rise condos are also not allowed. That's just a property requirement for where these loans are going. And like I said, if you've got bank statement income or if you've got any other occupancies that you want us to consider a second home or an investment property, please go ahead and still send it to us. You know, there certainly may be cases where we can consider exceptions and where it makes sense. So we don't want to miss any loans that we may be able to do. All right. That's all we've really got for I-10. I'll move on to, I'm really just going to cover the differences in our expanded prime and our non-prime programs. I've done some deep dives on bank statement loans in particular, which fall under both of these categories, but just to highlight some differences between these two programs. We have our expanded prime matrix here, and actually we just made some updates to this expanded prime matrix a few days ago, 2 days ago, you'll see. We've opened up the loan amounts to a max of 90% LTV up to a $1.5 million loan amount. Previously, to get 90%, you were capped at 1 million. So hopefully this will open up some more options for everybody. We can go up to slightly higher loan amounts now with that higher LTV. And you'll see again, we've got primary residences, second homes, investments. You can do full doc income, alternative doc income. That includes your bank statement loans, your 1099s, and your profit and loss loans. We do still have a minimum loan amount across the board of $100,000. The maximum we allow for expanded prime is 3 million. We've got 1 million max cash in, cash out on these, as well as 48 months seasoning on the expanded prime. So this is going to be your more near miss borrower. We want higher FICOs and lower seasoning requirements for these expanded primes. So again, for the expanded prime, we've got a 660 minimum FICO, so it's a slightly higher FICO requirement. Our loan amounts go up to 3 million. As I just said, the LTVs now can go up to 90% with the $1.5 million loan amount. That obviously includes, there's no mortgage insurance on these, over 80%. You can have a 1 times 30 housing rate in the most recent 12 months. We do want the borrowers to be 4 years out from any seasoning, credit events, bankruptcies, foreclosures. The standard DTI does go up to 50%. And then the loan terms that we're offering on this are your 30-year fixed, your 40-year fixed IO, and a 5/6 ARM. So that interest-only option can be a good option for borrowers that want that lower initial payment rate. It's a 10-year IO period followed by a 30-year fully amortized period. And we do qualify an interest-only loan on the fully amortized 30-year payment. So they'll make the interest-only payment for 10 years, but when it comes to our DTI, we are qualifying them on that fully amortized 30-year payment. We can do first-time home buyers, even under expanded prime. They're allowed on primary residences and second homes. And then non-warrantable condos are also allowed up to 80% LTV. All right, moving on to non-prime. actually, let me back up. We'll do your expanded prime income options. Again, we've got your full doc, your alternative doc, and then we also have asset utilization that's available under expanded prime.
Before we get too far, I had some questions on the other ones. I don't know if we want to just do them all at the end or.
Yeah, if you don't mind, we'll hold,
chat.
yeah, if you don't mind, we'll hold them to the end and then we can go over them. Okay, so we've got full doc, alternative doc, and asset utilization. For your full doc, you do have 2-year options for W-2s and tax returns, or you have the most recent 1 year. The 2-year option, the borrower does still need to be self-employed for a full 2 years, but you do have a 1-year W-2 or tax return option. For alternative doc, we have 12 or 24-month personal and business bank statements, as well as 12 and 24-month 1099s. Plus, we have a 12-month CPA prepared P&L statement option. And again, we've done some deep dive trainings on these alternative doc bank statement options. So if you are looking for some more detail on those, we've got trainings available for those. And then for asset utilization, you'll notice we do have a max LTV of 80%, and that's available on purchase and rate terms only. And I am going to go into a little more detail on that asset utilization option next, because it is only available under the expanded prime. So for asset utilization, these are loans that are ideal for your high net worth borrower. You know, they maybe don't have stable income, but they have a lot of money in the bank, or maybe they're retired and again are living off their retirement. They've got a lot of assets. They just don't show a lot of income. We can use their assets to qualify. It is only available for purchase and rate term options under expanded prime. It is not available for a cash out loan. And they do need to be personal assets that we're using. We aren't going to look at a borrower's business assets for these. We don't want to be depleting a borrower's business to qualify. But any personal assets that the borrowers have to use, we can use those to qualify. You'll see that we can use 100% of any fully liquid accounts. So your checkings, your savings, money market accounts. Anything that's in stocks, bonds, and mutual funds is going to be reduced to 70% of the balance. And then any retirement assets, if they are of retirement age, we can use 70% of those as well. If they are not of retirement age, we're going to cap that down to 60%. And the main thing we're looking for on this is the amount of assets they have available. And so your total needs to be either the lesser of $1 million left in the bank or 150% of your loan balance. And that is going to be your net of assets available after any reductions that you've applied according to the account, and less any closing costs, down payment, reserves, et cetera, that are needed for the loan itself. So once you come up with those eligible assets, you're going to divide your remaining assets by 84 months. And that's going to be our monthly income to qualify. It is a DTI qualifying program. So that's just, we're just able to average it over the most recent 84 months to qualify. So it gives us a little more income than your Fannie Freddie asset utilization that usually has to divide it by the term of the loan. We do need 6 months seasoning for any of these assets. So we're going to look at the most recent full statement that's available, and then we're going to get a statement from 6 months prior, and we're going to compare those two balances, and we want to see that they're about equal. The main thing we're looking for there is to see that the borrower has a history of maintaining this high level of assets. We don't want a borrower who has recently come into a lot of money maybe and doesn't have a history of keeping this high balance. We don't want any large deposits again that can't be sourced. Specifically, we get a lot of questions about whether they can use proceeds from the sale of a home to go towards asset utilization. The answer there is if it's seasoned for 6 months. So if they have a history and that money's been sitting there for 6 months, we can use it. But anything that they've recently received, specifically with proceeds from the sale of a house, could not be used. We are going to want all account owners to be borrowers on the loan. So if you have a husband and wife on any of these accounts, we do need both of them to be borrowers. The reason is they both have access to these funds. So we need to make sure we're reviewing credit for both of these borrowers. Gift funds can't be considered towards this asset utilization. It can be used towards the overall transaction if you need a gift for the loan to qualify, as long as the borrower meets the asset the total balance that's needed. So if they have that $1 million or 150% of the loan balance outside of the down payment and closing costs, you can use gift funds towards the transaction itself. They just can't be considered as part of the total assets to qualify. We do have a secondary option if for some reason this doesn't give you enough income, and you can use, again, this is a DTI qualifying program, so you can use assets along with any income if they have some to qualify. And if for some reason those two options together don't get your DTI where you need to be, we do have a total asset calculation option as well, where there is no DTI. And so we're just looking at the total assets that the borrower has available. In that case, the amount that we need to verify is going to be your total loan amount plus your down payment, closing costs, reserves, and then 5 years of monthly obligations. So for that, you're going to look at the monthly obligation, obviously, is our subject PITIA, and then it's another 5 years of any debts that are on the borrower's credit report, plus any REO properties that they own, the payments for those as well. So they usually need more assets for that to work, obviously, because you have to have at least the balance of the loan amount plus all of these things. But it can be a good option if your DTI is just not getting in line as well. All right, moving on to the non-prime matrix. So this is more, we have some recent credit event options for these borrowers. These are your lower credit borrowers. Maybe someone's had a recent foreclosure or bankruptcy. They're going to fit under the non-prime matrix. You'll see we have a slightly lower FICO requirement. We can go down to 620, but you'll notice under 660, that is for a purchase only, and we do cap the DTI at 43% in those cases. We have a slightly lower loan amount max in these. We only go up to 1.5 million on these, but we can still do primary residences, second homes, and investment properties. And again, we've got the same products available. We've got a 30-year fixed, a 40-year fixed IO, and then a 5/6 ARM. We do also still have our regular full docs, 1 and 2 year W-2 or tax returns, as well as the alternative documentation, 12 and 24 month bank statement, 12 and 24 month 1099, and profit and loss options. So the main difference that we're looking at between non-prime and expanded prime, again, is slightly lower FICO, more leniency on your credit event seasonings, and then we don't offer the asset utilization under non-prime. We do reserve that just for the expanded prime. But again, first-time home buyers are allowed on primaries and second homes. Non-mortgable condos are still okay. Cash out is up to 500,000, so that's slightly lower. But other than that, your expanded prime and your non-prime are fairly similar to each other. All right. So again, all of these resources, again, can be found on our website. If you go to the products page, click on NonQM, you can see we've got expanded prime, non-prime, DSCR, and ITIN categories. You can find all of our matrices and forms. That includes our business questionnaire for bank statement loans. It also includes our non-QM worksheet. If you're looking for scenario or pricing details, those can be filled out and submitted to our nonqm@maibroker.com email address. Feel free to send us any scenarios that you come across. Like I said, any exceptions, if you look at our matrix and we don't fit exactly in the bucket, please still feel free to reach out. We're happy to take a look at anything that you've got going on. And certainly if we can find a way to make it work, we definitely want to do that. So please feel free to reach out as you are going through any of these loans with any questions that you have. So with that, I will go ahead and stop our recording.